Sovereign wealth funds have existed for decades, but their profile, though, has risen considerably since the start of the credit crisis. According to the research company IFSL, funds assets rose to between $3.7 and $3.9 trillion by the end of last year. Marko Maslakovic is a senior economist at IFSL. Welcome, Marko. I was looking over the weekend, something like the main 6 sovereign wealth funds in the Middle East account for approximately half of everything under management, the assets under management.
Yeah.
How have the trends changed over the past decade or so, or half a decade even, in terms of what these sovereign wealth funds' role has become and where they're looking to invest increasingly?
Okay, well, as you say, the Middle Eastern sovereign wealth funds account for just under half of overall sovereign wealth fund assets at the moment. Asian funds account for just over a quarter, and European countries account for most of the remainder. I mean, there has been a growing prominence of Middle Eastern funds over the past decade. This has been helped in recent years by the rise in the price of oil, which has allowed them to accumulate assets at a greater pace. The Middle Eastern funds have grown at about 20% per year over the past 6-7 years. Now, IFSL's predictions are that in the coming period, this growth will slow. It should slow down to maybe 10-12% per year in the next 5-6 years. And another trend that we think will be evident is that Asian funds will become more prominent, and they will capture a growing share of this market. And our predictions are that by 2015, the current assets, which, as you say, are close to $4 trillion, should double. I mean, these Middle Eastern funds and Asian funds have been very active participants in the markets, especially at the outset of the credit crisis. They poured some $60 billion into Western institutions affected by the crisis. And they are sitting on some large losses on some of these investments, and they have faced sharp criticism in their own domestic markets for these losses. So basically, they have pulled back from investing over the past year to focus more on their domestic and regional markets. I mean, we have to remember that these countries themselves were starting to be affected by the global economic downturn. There was a sharp decline in the price of oil. So basically, they were investing to boost the liquidity in their own banks. They made infrastructure investments. And some of these funds were originally set up as stabilization funds, so it was natural for them to be used up as...
Marko, obviously there is a problem of definition. For example, you talk about the Middle East. It is very clear that an organisation like the Kuwaiti Investment Authority or the Abu Dhabi Investment Authority is a sovereign wealth fund. If, however, you have discussions in Riyadh and say the Saudi Arabian Monetary Agency, are you a sovereign wealth fund? The answer is very clear indeed. No, we're not. We're a central bank. You know, likewise in Beijing, I think it's very clear that China Investment Corporation is a sovereign wealth fund. The reserves of China, which were announced at the end of last week as having risen to $2.1 trillion US, are largely managed by the State Administration of Foreign Exchange. And one can get into a debate about, is that a pure sovereign wealth fund or not? And I'd just be interested in your thoughts on, how do you deal with this definitional problem? And I can go on using a whole series of other examples.
Yes. I mean, as you say, it's not very clear-cut. I think the definition of a sovereign wealth fund is a government-controlled and owned pool of funds that is funded from official reserves but managed and invested separately. There are 3 distinct groups. There are the sovereign wealth funds, there are other sovereign investment vehicles, and there are the official foreign exchange reserves. Official foreign exchange reserves are held in short-term investments so that they can be readily available for monetary policy purposes. Other sovereign investment vehicles could include, for example, pension reserve funds, state-owned corporations that can have their own funds. So it's not a very clear-cut distinction, and there is no official register of sovereign wealth funds that would sort of...
The problem, Bob, is not the pool of assets or the pool of...
No, the interesting question is, how is it invested?
Exactly. Yes. And that remains fundamentally the problem that I think we have in determining whether they are a benign or a negative force for capitalism writ large, to be honest. I mean, it's ironic that if you just stand back and take a look at this sector, why on earth is China running reserves at these levels at these levels when a good proportion of the country is struggling to feed itself.
Well, don't forget, a lot of work was done last year, which came out with the Santiago set of principles on, corporate governance is the wrong phrase, but let's say governance and behaviour of sovereign wealth funds. And I think a lot of progress was made last year to head off some of the criticism that we saw back in late 06 and 07 as to the opacity of sovereign wealth funds. So I think actually you now have much better transparency than you had 2 years ago. Now, if you ask the question, why has China got $2.1 trillion of foreign exchange reserves, the answer is very straightforward, which is a very competitive exchange rate backing a very powerful trade surplus with, particularly the last 3 months, very strong capital inflows. And that's reflected in SAFE's numbers.
But if you look around, you can take the China example, you can look into the Middle East, and you can look at countries where populations, by and large, are still below the best standards of Western education, of food consumption, and wealth per head of household, and so on and so forth. And yet some of these economies are running the largest sovereign wealth funds, and you just ask yourself, does it make any sense at all that they have this capital available, of course, to go and invest in equity and to do all these other things, but why is it not being redirected back into the domestic economies to improve the standard of living of the people that live in those countries?
I think they are starting to do this more, especially over the past year, and I think that may be a trend that might become more evident over the next few years. But we have to remember that sovereign wealth funds, the original purpose of sovereign wealth funds is to preserve and maximize the wealth and transfer it between generations. And their domestic markets simply do not offer them enough opportunities to do this, whereas the Western large liquid markets are offering them the opportunities on large returns on their investments.
Sure. Huge sweeping statements, of course, but I think it's something that you've got to ask yourself.
But just look at infrastructure in China today relative to infrastructure in China, when you and I first went there, sort of 20 years ago. And, it is wrong to say that all this money has been accumulated at the State Administration of Foreign Exchange and an insufficient amount has been spent on domestic infrastructure, because I would argue that parts of Chinese infrastructure today are absolutely world class.
But education, for example, if you look at Saudi, a prime example where a very rich country as such, and yet the education system is lacking and is so far behind other Middle Eastern education systems as well. But that's down to the structure and down to the system of the actual system and how it's built and how it's governed, and not so much the money that's put into the system. I would argue that they're apples and bananas. You can't necessarily put them together.
Sportboxeurope at CNBC.com is our email address if you'd like to, maybe I'm just talking out of my head as usual, just complete bunkum. But your contribution's welcome, of course. You've probably got a much more intelligent view. Marko, thanks very much for being here with us. Marko Maslakovic, senior economist at IFSL.